All right, hey everyone. This week is going to be a very big week for the market. So, what is happening? So, tomorrow, on the 17th of September, the Federal Reserve is going to make a decision whether they are going to cut the rates in September or not. Okay, so Powell is going up the stage to speak tomorrow, and probably the whole market will be watching at this event. But I am sharing with you in this video to stop betting everything on rate cuts. Okay, so in this video, I'm going to go through with you what is the market expecting, as well as my personal opinion on how the market is going. So be sure to watch till the end of the video. Now, before I begin, if you haven't done so, I would really appreciate it if you could hit the like and subscribe down below. It really helps me to keep making this kind of videos for you. So without further ado, let's get started. Okay, so what's happening tomorrow, right, is this Federal Reserve FOMC meeting. And as you can see, right, what is the market expecting right now is that traders are pricing a 93% chance that the central bank will cut the rates by a quarter of a point, so 25 basis points, right? So all this kind of data, why did they price in 93%, is actually because of the earlier macro data that has been released. So like unemployment data, the inflation data, which is represented by the CPI and the PPI. So we're going to take a look at that later on. But what are the other things that actually led to this thing, and what should you actually observe when the Fed talks about the rate cut tomorrow? So as you can see right now, right, on tomorrow, this is the rate cut for tomorrow, 96%. We are at 96% right now. And this is not the only thing, right? It's not that the markets is just expecting rate cuts in this September. Oh, that's it. So, I shared that they were looking at many different data from inflation to unemployment. And the data were moving in a direction, right, that actually caused many banks, many analysts to expect 3 rate cuts this year. So, guys, just do the math. We are in September right now. Okay, so tomorrow is expected rate cut. It's more or less confirmed already lah. And then you have another 2 more meetings, which is in October, which is in December. So basically, right, the whole market is expecting that in those 2 meetings, the Federal Reserve will still cut rates. Okay, so that is already being priced inside the stock market, right? Because the market is always forward looking, right? They always see the data, and the market, the share price is always a forward-looking indicator. So it's not like right now the market hasn't priced in the rate cut tomorrow. So if let's say nothing happens, right? If the rate cut happens tomorrow, probably nothing will happen to the market because it has already been priced in. So it's very important to remember that the market is always forward looking, right? And as you can see, right, what are the probability that they are looking at for October and December? So October, right now, they are expecting a 77% rate cut probability end of October, and in December a 70%. So you can see it's quite high. It's not like a 20%, 30%. So you can see that this expectation has really been baked into the market. So let's do a very quick recap. I shared this in my last video about what is the dual mandate of the Federal Reserve. Basically, what is Powell's job when he come to office. So when he come to office, right, he has 2 tasks. His first task is to say, hey, I'm going to make sure that the US economy is healthy, that everyone must be, as much as possible, everyone must be employed. Okay, and how he gauge that is this benchmark of maximum unemployment and a benchmark of a 3.5 to 4.5% unemployment rate at the cap lah. Okay, so this is their projection and what they are expecting to be. The second one is price stability inflation rate. So they want to, basically this means that, hey, I want to make sure that the cost of goods for average US consumer is not too expensive. So it's like, oh, maybe today my milk costs $4. The next year I want it to cost probably just $4.10, that kind. And they don't want it to become like next year suddenly become $4.50, that kind of thing. So it's to manage the economic growth of the country, as well as ensuring that everyone gets employed and money, inflation will just go up at a very, very steady rate, a linear curve in the long run. So this is their goal. Okay, but let's look at where we stand out on both sides, unemployment and price and inflation. Now, this is for inflation first. So this is represented by the CPI, Consumer Price Index, which measures the change in consumer prices at the consumer side. Right, so as you can see that the month before, right, it was actually 3.1%, and at that point of time, it kind of shocked the market. Why? Because everyone thought, oh no, inflation is high. Every tariffs is coming. Goods are getting more and more expensive. Right, so people are thinking that inflation is going to rise drastically. But what we saw that is that in the latest results, which was just released, I think last week, right, that this CPI maintained at 3.1%. So it did not increase even higher, right? So this is a good sign because to the Federal Reserve, right, if this number gets higher, then it's going to get concerning, right? Because if the CPI gets higher, right, it means that cost of goods are getting more expensive. But if you reduce the rates, right, more people got more money to spend, and then it will cause the inflation to rise higher. So they don't want that. So it maintaining is a good sign. Now the next one is PPI, which basically measures, it's called Producer Price Index, which measures before the consumer, like from the supplier side, right, when they receive the goods, right, are there any price changes lah? So you can see PPI actually decrease, okay, from initially it was 2.8, 2.9% for the PPI, and then it dropped to 2.6. And the other one is the core PPI, which maintained around 2.8. So nothing alarming. So these signs, right, tells everyone, the Federal Reserve, that, oh, inflation is under control, right? Is what we expected. Tariffs is a one-time effect. And it means that to them, instead of focusing on two problems, inflation and unemployment, they can now focus on unemployment. Why? Let's look at unemployment right now. This is the current unemployment rate. You can see that it has inched up slightly to 4.3%. So remember, guys, what is the benchmark that they want? They want 3.5 to 4.5%, right? 3.5, this is the benchmark to 4.5. So you can see that it has actually been managing the rate, that level since 2022, right? But now 4.3% is nothing alarming, but it's slightly on the higher side. So, but it increasing shows that unemployment is getting a bit of a problem. But not only that, right? There's also another thing, which is the jobs growth revised down by 9,000, okay, close to 1 million. But the key thing, right, you just see over here, you just see how the number of jobs are actually decreasing on a downward trend. So basically, there are lesser jobs being created in the USA. And then there was this revision which caused that instead of jobs being created, right, there were jobs being deducted. Right, so this basically tells signs. These are signs of unemployment. That like there are lesser people, there are lesser jobs available for people. And imagine the same group of people finding jobs, but jobs are decreasing, right? Then it's going to get harder for people to find jobs. So this is where the Fed is focusing on. So to them, it's like, oh no, unemployment is a bit high. Right? How do we bring down that? Right, that's the reason why, based on this data that you see, right, everything is leading towards the idea of a rate cut. Why? Because if rate comes down, it becomes cheaper for company to borrow money. When it's cheaper for company to borrow money, which means they can hire more people, which hopefully will help unemployment. So that's the whole idea of rate cut. All right, now before I continue on, right, if you enjoy this kind of insights, right, I've got a free Telegram channel where I share a lot more than just what you're seeing now, including some stock markets insights, updates, and sometimes I just ramble about life or some mindset stuff, like a little bit philosophical, but I kind of like enjoy. So if you are that kind, right, I think we will click very, very well. Okay, so feel free to pause this video here, scan the QR code, or you can join directly from the link in the description box down below. Now, let's continue. Okay, so let me share with you, all of you. Actually, right, the key thing that markets will be looking at tomorrow is not whether there's a rate cut or not. Okay, it's not whether there is a rate cut or not. So this is the plot twist. Okay, because everyone already expected a rate cut. Correct. So if the Fed's cut rate tomorrow, there'll be no surprise to anyone. But remember that what are people expecting now? They are expecting 2 more rate cuts in October and December. Okay, so what the market will be looking at is what Powell is going to say. Is he going to say that, give some, so he doesn't say things directly one. Usually they won't say, oh, there will be a rate cut coming on October and December, right? But they'll be watching for what he says and what the minutes will come out right over here. These minutes every time for the FOMC minutes, right? When the meeting is over, they will have these minutes of what exactly did he say. So you can see August is one. This is where I think they cut rates once over here or in July, and then this is the event here. Okay, this is the minutes that everyone were looking at. Okay, to go and basically this is the rate cut minute, the rate cut, whether they're going to adjust interest rates So in September, this is the one that is happening tomorrow. So what is the market looking at, right? They are basically going to see whether Jerome Powell is going to be dovish. Okay, this is a term, dovish. Just remember, dovish is like very, very relaxed or is he going to be hawkish? Hawkish is like he's going to be very fierce. Okay, so in terms of rate cut, dovish means that he is going to be like, okay, there's going to be more rate cuts. He's going to give some indicator and say that right now, maybe he won't say direct, but maybe he's going to say things like, right now we see the unemployment data getting up, and as we expected, inflation inflation is under control. Okay, so everyone, I tell you, everyone will have their earpiece, everyone will be super focused, and even the little words that he say has effect on the market. So he's going to say that, oh, because of this, we might probably have consider to see whether we need to do some adjustments in the next two meetings. Right, once he say that, right, it means it's dovish. But if he comes up and he say that, okay, guys, unemployment rate is high. We think that this one rate cut will fix the problem. And because the inflation is still very, very high, we are prudent to be more cautious and careful and wait for more data before making a decision. So if you say that, oh, I tell you, the whole market will like, oh no, is a rate cut not going to happen, right? Or is a rate cut going to happen, right? So these are what people were looking at. Okay, are going to look at. It's not about whether he's going to cut rates or not already. So this is the two terms are dovish. So remember, a dove is very peaceful, flowing, enjoying the wind and all. What is a hawkish? A hawkish is a bit more fierce, getting ready to go and pounce and going to attack. So that's how you differentiate between dovish and hawkish. Okay. So what does it all mean, right? Okay, so this is just a summary. The market is already priced in 3 rate cuts for 2025. Basically, the next 3 meetings is going to happen. Everyone's going to say rate cut, rate cut, rate cut. Okay, and September cut, which is the one happening tomorrow, is basically confirmed. I don't think there will be any surprises. This is what everyone has been expecting, and what really matters is what Powell says lah. So if he's very dovish, it's very nice. He say that, oh, there'll be more cuts, right? We'll probably see some sort of a little rally. This is my personal opinion. Market is probably ready and they like the excitement And hawkish is when he say that inflation must drop first. Markets may not like it. Okay, so this is a summary. But if you ask me, right, what do I see? I'm not talking about the short term in the next tomorrow in this week. Now, remember that what we want is we want to think bigger picture, right? Whenever we see things, you must think big picture first. It's like when we want to go and work on something, a big project, you must look at the whole project as a whole first, right? Then you break into individual pieces, right? So to me, in the long term, right, okay, these are all market noise. All these shorter things, right, they are all market noises, right? And it has been evident since many, many years, decades, centuries in the stock market, right? And all these macro news, right, it affects the short-term movement of the company. But more often than not, right, in the next 6 to 12 months, data have shown that regardless of this kind of whether they cut the rates or not, right, data have shown that usually market goes up. Market is always higher 12 months later, right? Why? Okay, why is this the case? Right, let me show you this chart. Okay, is that in the long run, sales growth, which is company fundamentals, revenue growth, which flows down to the profit, right? Sales growth is the key driver of long-term stock performance. Okay, now this is important. So you can see that in 1 year, right, sales growth probably affects a small part. But in the long run, the sales and the profit, right, will make up the most part of a long-term stock performance. Okay, so this is even though this is since from 1990 to 2009, it's actually still valid until today, which is that in the long term, right, what contributes to the share price of the company, right, the most of it is actually the fundamentals of the company, right? How well the company is, whether, right, regardless whether times are good, whether the Fed cut rates or not, will they continue to do well or not, right? Because if, let's say, the Fed cut rate and the company is susceptible to this, then that is a bad company, a company that is affected by the macro news. But if regardless if rainy weather or sunny weather, you can still drive your car out, which means the company can still thrive and sustain, right? Then in the long run, that's all that matters, right? So stocks will work very well for long-term inflation protection and macro protection, right? So at the end of the day, right, don't let this scare you. That's why you see the first slide as well. Stop betting everything on rate cuts, right? I see some people that are saying that, oh, I'm going to. I saw some video of people saying that, oh, I'm going to sell my position. I wait for the rate cut for the market to retreat. Hey guys, remember, great companies or S&P, right, will always be its all-time high one, right? The worst decision that you can make is to sell out of all your positions, okay? So that is my point, right? And remember, time in the market is always better than timing the market. Okay. Now that's the end of the video. But before you go, I hope you enjoy this video, and I would definitely love to connect with all of you, right? So feel free to follow me on socials if you enjoy this content. I post TikTok video quite frequently. On Facebook, I write quite frequently. On Instagram, I also post videos quite frequently, and also some snippets of my life. So whichever platform that is convenient for you, you can also find the link down in the description box below. There's a lot more links. Feel free to follow me. If you want to follow me on all That's amazing, right? I would love that. And hopefully, I'll see you guys very, very soon and stay tuned to the next video.